see from the pacers in this match. On either side, a lot of those cutters and pace-off deliveries. As the game wanes, as the game goes on, we see some risking up to them from now as well. It's 1-8 on field, 13-1.
First of all, can you hear? I'm audible? Am I audible?
Yes, sir. Yes, sir. Yes.
Yes, yes, sir. Yes.
Very clear, because the last session in the class there was problem. Very clear now. Somebody has to unmute and tell me. How is class? Slide is disabled. Second. I think participants have to unmute, otherwise the echo will come. Mute your audio system. Sarita madam,
Yes, sir.
I'm audible now.
Oh, yes, sir, you are audible.
And,
I think,
what
sir, there are 8 minutes left to start this meeting.
No, I'm just checking the
So
system
we
now.
can wait. Yes, sir, it's okay.
Meanwhile, we can start the, starting checking on those things. The slides I shared, you might have seen it.
Okay.
I will again share the slide. Any problem, you tell me. It is visible, right?
Yes, sir, your screen is viewable.
Okay. The next screen is also visible, right?
Yes, sir.
So let participant join. I know that time.
Good afternoon, Sharma sir. Shall I start the meeting? Okay, sir. Namaskar and good afternoon to everyone connected to this webinar. Respected speaker of today's webinar, Shri Kumar PR, our chairman, Shri S.P. Sharma, and esteemed participants. I, Sarita Singh, CEO, Divya Jyoti Wellers Foundation, extend a warm welcome to you all in this program. As you are aware, the topic of today's webinar is significance of diverse world of unusual variety of values. Value as a concept has different meanings for different people. The value of an object changes from time to time as well. Hence, value is a relative term and depends on people, perceptions, time, and circumstances. This aspect brings diversity and variety in kinds of values, which appears quite interesting. Valuers need to know the correct meaning of various values and terms so as to use them correctly in the valuation reports prepared by them. We are sure that participants will find this topic useful and enriching for their professional practice. We are fortunate that a highly experienced and a qualified professional, Shri Kumar PR, is taking this session on this subject, who will cover its all aspects in details. Before I hand over the mic to him, I will briefly introduce him to you. Shri Kumar PR is a chartered engineer and a registered valuer for asset class land and building. He worked as project consultant for over 35 years in India and abroad. He has valuation experience for more than 15 years. He is an impaneled valuer for a number of banks, which include SBI, Canara Bank, SIB, PNB, HDFC, etc. He is a registered valuer for CIRP and liquidation cases. He is an experienced faculty since 2018 with various RVOs for IBBI exam preparation through MEP classes and CP programs for registered valuers. Sir, over to you for a wonderful learning session of 2 hours.
Thank you very much, ma'am. Wonderful for encouraging words. And my introduction is already given by Madam, and that is the value, about value. So value differs, as per the circumstances. And some of the common terms we are misusing it, that nomenclature, you can say. So in that case, how we have seen so many valuation reports in which minor mistakes are there, or sometimes even it won't as a valuation report is your ambassador. So the wording should be correct. For example, I will tell you fair market value. You will just write. It's not enough. For what? Fair market value you are certifying for mortgage or tax purpose or insolvency purpose. That purpose should be written. Many of us forget this point. If it is taxation purpose, okay, you write it fair value of the, because values changes, for the purpose also. So in that context, we'll start with a few values as well as new methods of finding out values. For example, we are not familiar with easement way valuation, easement rights. So that also I would like to introduce here. Then we don't have much knowledge about, I hope we are all LNP or P&M valuers. If there is any security and finance people,
Yes, sir. Security and finance people.
oh my God, okay, you will kill me today. Okay, some of the words are taken from security and finance asset class also, which we should know, at least other asset class should know it. What is exactly the meaning? So that they will also, so you can contribute something in this webinar session. Let me start with sharing the screen. And whenever you want security finance people has got any input, please let me know. Okay. Let's start the class. Session. Okay. So this is also, see, public has got different perception. Their views are different in different values of different significance. Public, general public, but a small difference will make things, go for us against us. So be careful when you use the words value, different words of valuation, values in an evaluation report. So as we know, it changes time to time, and also the purpose of which it is computed. Let me see, you can certify 3 or 4 values in a day for the same property, if the purpose is different. For capital gain, you might have certify some value. For mortgage purpose, you may certify some other value. So purpose is made, purpose of valuation. So you can certify 4 or 5 values in a day for same property, if the client comes to you. Okay, so I'm telling you. Okay, the value of an investment can vary according to income level. So investment value also, we are today we'll see some of the intricacies of you're asking me something, Kopala sir? Maruti Kopala sir? Okay, we'll have a discussion in the last. Otherwise, you can type it in the chat. If it is, it won't. We cannot finish. You can type the whatever queries, whatever I know, I will share with you. Okay. So the value of an investment. So investment value, you will see that depends on income level. It's a subjective word, because how much investment you have to decide. Then investment value, what is the use of that property in your view? If it is highest and best use, have principles, and all, it depends on the person or entity, income level, insights, whatever their perception is, and usually be the proper usability of the property. Property, how can you use it and get is return of capital. Okay, so these are the, then comes business valuation is a process used for estimating economic value of the whole business. Business values are, it's an economic concept actually. See, valuation, though it is an art and science, we say maths and this thing, but basically it's an economic term. Many economic factors are affecting values, mainly. Microeconomics, macroeconomics, all those things you should be familiar with, because you are a company valuer now. Now you have to go to some other place. You have to learn, study during your inquiry, what is the economic status, population migration, all these things, population density, scarcity of land, everything you have to study. Then only you can prepare a good valuation report. If you are going outside your state, most of the cases you will get outside the state. Okay, somebody else there in that waiting room? I think DJF will take care of. No. Think that, okay. So, business valuation is a process used to estimating the economic value of the whole business. Then we'll come to common terminologies, very common terminologies. We are learning this from MEP. But no. Yes, Mr. It is echoing. Can you please mute Nitin Agarwal ji? Please mute your microphone. Those who are in, using it will see the echo issue is there. Nothing else. Okay, now it's all right. Thank you. So, book value, we know it. We are learning it. But here there are some importance because other values depends on how, especially liquidation value, when it comes. Liquidation value is always higher than book value. It's almost, so these kind of things we have to, while you are preparing a valuation report for a CIRP or liquidation process, book value is important. What will be the book value of the particular property? Okay. The value at which assets and liabilities are recorded in the books of accounts of the entity is called book value. So, as we know, the valuation, it is fine. We know that securities and finance people will be doing the return down value method, and easiest way is we have some our own way, the linear equation or constant percentage method. You can find out the book value of the particular property. Okay, so accounting principles used in recording the value of the assets and liabilities. The interesting part is book value is an accounting term, not a valuation term at all. Okay. But however, you should know this, what is a book value. Then comes depreciated value. Let's see. So again, unmute. I can hear the echo here. Okay, please unmute. Mute. Because echo problem is there. Depreciated value is equal to the value derived, after depreciation of the asset, or net depreciated value. Okay, net amount. These things very common, just to revise. Now comes other most common terms like the fair market value and market value. Definition of this term is widely accepted and frequently used in valuation purposes. But it is always diverse in meaning with the situation. From market exposure. Please unmute.
Please keep your mic in mute mode.
Yeah, mute.
It is disturbing other members, please.
Please. Because it is disturbance to others as well as me also, because I get echo, whatever I am saying. Please cooperate. So fair market value and market value. So this is the legal aspects and interpretations. Okay. The broad definition of the term, the valuer needs to accommodate government regulations, acts, guidelines, of government bodies, legislation, etc., for determination of market value. So suppose there are legal implications, means there are restrictions. Zoning restrictions are the airport proximity restrictions are there. Then high tension electricity restrictions, everything it will come under. So, but we should in first sentence it should be very clear. We are applying those restrictions in the value. So when you write
Sir, you are muted, sir, you are muted. Please unmute, sir, unmute.
Madam Sarita, are you there?
Sir, yes, I am there in the meeting.
Please mute the members centrally.
Okay, sir. Sir, even I am
Hmm.
losing my connection again and again. That's the problem.
okay, somebody has unmuted me also. Okay, no problem. So let's continue. Now, I hope it's clear for all of them. Audible at least. So fair market value of the property for taxation, you can write. So you are, when you are doing a particular valuation asset for taxation purpose, you will take into account of government guidelines, regulation, acts, etc. It is understood. Otherwise, there will be a confusion whether this valuer has taken into consideration of these things. So the fair market value, when you certify, you just write the property for taxation. So purpose is written there. State in the purpose. Okay. This indicates the conditions and factors under which the valuation process is undertaken must also stated to avoid uncertainty. That uncertainty fact you are removing. See, a good valuer always be, no ambiguous, unambiguous wordings should not be there. It should be clear to a layman even. Okay. Second thing is, when somebody is reading your report, he should feel that he is on site on the particular property. You have to give a exhaustive report on all the observations you have made, everything. So in a beautiful way, nice, simple English, so that people can understand. Anybody can understand, because this subject is the paradigm shifting of valuation profession. Most of the clients you are dealing with is ignorant about all these IVS standards, or what is valuation, how we are arriving the value. So we should be very clear. These are the things we are doing. Okay, and get your good professional fee, whatever you are deserving. Okay, so that is number one. Then comes uncertainty factor is avoided. Then another definition for fair market value provides, that is income method. It is also called fair market value. Another definition of fair market value provides a useful guide in the process itself. So when you are going for income approach by DCF method or market capitalization or EBIT, whatever method. So there, what you are finding out, fair market value, present fair market value is equal to the present value of the future benefits. So naturally, you need not elaborate the fair market value. Fair market value by income approach, that's all. because it take into consideration of only income part of a business or whatever. While you are using market approach or other approach, you are comparing with other properties. So that is the main difference. So fair market value can be written as fair market if it is income producing property. So we know that income generating property depends on present value of the future benefits. That is, the one word for that, time value of money. Okay, it basis is time value of money. I hope it is clear now, because don't write. These are all this type of classes when you attend, when you're doing a company valuation, it will be very useful to you. Okay, so take care of these things. Go to the next a graphical representation we'll show. I'll show you. Very interesting. See, in x-axis time factor and y-axis amount. Okay, it's a real estate property, fair market value. Okay. First one we will take seller's subjective estimate. Okay. Seller's subjective value estimate. So seller has got an estimation in his mind. Subjective. It is subjective. He always think highest value. That is why in rupees. Then whenever I will give you an example. A script has given to a producer or director. He will after reading all those things, he will think, oh, this is a good blockbuster. It may become, because it's a nice script. But unfortunately, it won't work out every time. So that is subjective. Subjective means by personal opinion, personal perception. So that is why. Then when the time goes positive side, what happens? His expectation reduces to S, point S, right? Okay. Yeah. So why S? So just by heart, not by heart. You just note it down, because next slide we don't want to come back again. I will give some. Okay. This is seller subjective area. Now, you see, OB curve, that is buyer's subjective value. Buyer has got what? If he gets free, okay, fine, I will take it. Or if he get a minimum price, this is O represents minimum price, not actually zero. Buyer expects a minimum price. So, but it may not be a workout. Because cost of material, construction material is high nowadays, so it will go up. Buyer's subjective value. So these are the two terms: seller subjective value and buyer subjective value, and it coincides at point P. But here, what happens? Seller is also expecting P. Buyer is also expecting P amount. So there is no gain for anybody. Both are, expecting the same thing. Seller, okay, P is also expecting. So gain is zero psychologically. Then comes here you see PBS. Suppose it's a triangle for time being, explanation purpose. PRS. This is the market in which our role is there. We are going to value the property. See, there are P is there, then Q is there, then after some time it becomes R and all. So our role is to get the market value feasible, which is acceptable for seller and buyer. So this area is called market exposure. Okay, here you see. Okay, the shading, right? something like this. This is the market. So here, on the valuer's role comes here, this particular area. Okay. So we'll see, have some explanation on that one. Same thing is there in the explanation part. Anyhow, you have to just say curve YS, as I told you, YS, seller's subjective curve. That is estimated of a real estate by the owner. Owner always estimate, from beginning he has got a higher expectation. Maybe it won't work out. It will come. Curve OB, subjective value of estimate at various time of real estate buyer. It is buyer's curve. You cannot say a buyer's curve in the real sense, but subjective. Here we are concentrating on the word subjective. That is by person, that particular guy, that particular person. Then point P, intersection point where value estimates of both parties coincide. So what happens there? At this point, no transfer. The transfer would be not gaining anybody. A seller is expecting the P and buyer is also expecting P, and no gain at all. Subject to estimation. Okay. Now space between PB and PS, that triangle I told you, hatched. That PB and PS is the market exists. There only the market exists. An area where valueless activity exists. When market exists, our existence is there, right? An area of negotiation also. They can negotiate personally, not only. But to find out a reasonable price is our role. A market value can be certified at some point of this area, say Q. You may certify Q. But this Q should come from our procedures, IVS standards. We compare with other properties and give weightages to the positive and negative factors. Then only we are going to give a particular value for a property. So that is a market value can be certified to some point of the area, say Q, where a sale purchase can be made. This is, you are going to certify the fair market value of the property for selling or purchasing is Q. Finished. Now there is a word always we have seen in IVS standards, fair value. Fair value is for a reasonable period and influenced by growth potential of replacement cost. It is all influenced by the growth potential also we are taking care of, that particular area growth, or even the subject property. If there is a possibility of growth, that will also take into account in fair value. Please note these things, okay? Market value and fair value has got many changes, then reflects in the intrinsic value. That we'll see what is an intrinsic value. Whereas market value changes frequently. Other one is changes slowly or fairly a longer period. Because we are taking care of all those factors. Whereas market value changes frequently. Then influenced by supply and demand. Here, fair value, we are not considering about supply and demand. Market value, market is supreme, of course. Market value is always influenced by supply and demand. Then determined by current market transactions. Because we are comparing with other properties, current market condition. So that depends on market condition. But whereas in fair value, we are considering the intrinsic value. Okay. So it is estimated price of which an asset is bought or sold when the buyer and seller freely agreed on a price in an orderly exchange of an asset or liability under current market condition. It is impartial and estimate of the intrinsic value. Second point is individual and business may compare current market value, growth potential, replacement cost for the fair value of an asset. So this is in short. I have given a table there. Through it, and that will be the procedure to find out. Okay. Now let's see what is an investment value, or the real meaning of investment value. We all know it, but even though we have to go in depth, a little more knowledge about investment value. It's a value based on expected earnings or monetary terms return to an investor. Right, we know it. It is value based on expected earnings or monetary return to an investor. So probably by inquiry, by local inquiry, or some thumb rules may help you, but the local inquiry is required. Expected earnings. You cannot expect earning of 5%, where the area is 3 particular area. It is only 3%. You cannot expect anything. You can dream anything, but the reality is you will find out by market inquiries. So market study is one of the important factors for a value. Have to go to the market and get the information even from, see, this information you may get from advertisements, you may get from some real estate portals, you may get from even a coffee shop owner, poor fellow, some information. This really happened to me, so that's why I'm telling. These people will tell openly, talk openly if you are friendly with them. So that depends on, these are all inquiries. It is based on the individual subjective goals, criteria, and opinion about the asset. And it does not always reflect the asset's true value or market value, which is impersonal and detached. So that is investment value. That is as a true asset value, they are taking care of, taking into account of investment value. So let's compare market value and investment value. Market value is the price that is currently offered for an asset in the marketplace. That reflects current market conditions. Market conditions are very important. That depends on even macroeconomics, GDP growth, population growth, everything will come under this one, as well as micro aspects, immigrant population, all those things. So in market value, we take into account of everything, all these market forces. There is a theory, market is supreme and market is ruthless also at the same time. So investment value, the value that an investor is willing to pay for an asset or investment based on his or her own objective and parameters. Here investment value is taking into account of the subjective, again subjective here. Okay. So here, the value that an investor is willing to pay, that is investment value. Based on what? Based on his subjective perception or an objective, or many parameters may be in his mind. So I should get after 10 years, all those things. I think security and financial people can elaborate in this one, because discounted cash flow is, they are doing it. It's a reasonable period of time. They are predicting but after that also the property has got the value, future cash flow. That also taken into account. We have to take it into account, because DCF method, we know that we are for 5 or 6 years, 6 years we take. The property is for 70 years or 60 years. So future cash flow maybe that will add to the terminal value. That we'll see later. Okay. So that is called investment value. Now going concern value. What is going concern? So it's a healthy business, not closed down, in a foreseeable future. Foreseeable future. You cannot, it will go on in the business. So going concern is a term of company is financially stable enough to meet its obligations and continue its business for the foreseeable future. Because it is valued under normal operating conditions, it would be typical to express like fair market value on going concern basis. Here, if you are taking business valuation, especially in CRPC process, you can write this word fair market value on going concern basis, and otherwise investment value on a going concern. It depends on the situation. Okay, here the purpose should be written. Without the assumption of continuing operations, business is essentially only worth its breakup value. What is breakup value? Piecemeal basis. Okay, breakup value can be quite low actually, especially when there is a bidder from a firm's assets. However, with the going concern assumption, an acquirer may be willing to pay much more for a business than book value. So that is by common practice, it will be always higher than book value, going concern value of its asset might imply. When paying going concern value, an acquirer would be willing to pay goodwill also. Here we consider goodwill, intangibles. So goodwill, like breakup, variety of intangible assets, including customer loyalty, intellectual property, managerial skills, etc., or customer relation, in short. So that goodwill also we have to take into account. Other things also should be there. Somebody has marking. Okay. So next. He has to do that. Please do that. Are all matured. We are all valuers. Don't do such things, please. Because I am not, I cannot do now the remove that the red line, It has not done maybe somebody. Please do it. Okay. Next slide. Liquidation value. Going concern value, then comes liquidation value. What is liquidation value? Is the total worth of a company physical assets if it were go out of business. So business is CRPC process is failure. Suppose. Then it will naturally the creditors will get some relief from the liquidation only. So liquidation value is total worth of the company's physical asset. Here goodwill, that thing, this thing is not considered because it's already gone out of business. So physical assets, it were to go out, business and assets sold. When asset is sold, it is called liquidation value. In one clause is there, remember, in a saleable condition. That is the difference between bank valuation, mortgage, financial institution valuations, and company valuations. In financial institutions, we auction it or they auction it, distress value or forced sale value, whatever you call it, auction value. As is where is basis. So as is where is means that it may be after 5 years. So many bushes will be the stray dogs, even trees inside the house. I have seen it. So these kind of things happen. So it is not saleable condition. Whereas liquidation, you have to take into consideration of saleability. That means if you want to spend some, the new owner want to spend something, you have to deduct that amount from the value. That is liquidation value. For example, if you are giving so if you are giving a value of 85% of market value for as is where is basis, in liquidation value it may be 75%, right? To make it saleable condition. That you can calculate actually. How much you will require for cleaning the area or building is already dilapidated. So removal of building debris. Then you will think about Habu principle. Then you find out that it is good for a what you call residential buildings, gated colony. So you need not do that, but you have to draw the roads inside, open spaces, etc. So what will be the cost? That you have to take into account in liquidation process. Sometimes it is you have to make some filling, earth filling. So you can find out easily the earth filling volume, unit rate that you will detect it. So you get liquidation value. So that you can convert into some percentage. That percentage you detect. So liquidation value is determined a company's as any doubt you can ask in chat box. Or question answers QA is there, no? Please raise your voice, sir. Thank you. Hey, why? Who is doing this? Please stop it. Please, I request you to stop annotating yourself. Can you please stop it? This red line, the yellow line, this, why you are doing it? If you are not, you are particular about annotation, I will do it. Please remove those markings, those who have done it. Okay, then that red line also, sir, please. Then everybody will be comfortable, in a comfort, you can take the class in a real comfortable way. This 2 hours class, which is valuable classes, then more topics are covered. So you have to, most of them are very important for us. Liquidation value is usually lower than the book value and but greater than the salvage value. Yes. That is also, I hope, clear for valuers. Okay. Liquidation value does not include intangible assets. Yes. All are gone, intangibles. While you liquidate it, there is no goodwill, there is no patency, there is no, even if they are given, government has given some patency, some pharmaceutical firm or anything, everything will be lost. That intangible asset you are not going to value. Not to take into consideration. Goodwill, brand recognition. What is brand? Toyota car. If it is go to for liquidation, suppose that brand recognition also gone because it was with some other management. Now the whole management is changed. Customers doesn't know what is going to happen. So you need not value the brand, that emblem, brand recognition, etc. for a liquidation process. However, if a company is sold rather than liquidated, see, sold, when it is sold, not liquidating. When a company is sold rather than liquidated, both liquidation value and intangible asset determine the company's going concern value. Here, you are selling it because of some reasons. Still that intangibles will be there in selling process. You have to take into account. If he's ready to sell to somebody, then as you know, the entire goodwill as well as brand recognition, everything will be intact. Okay. Okay, fine. Value investors look at the difference between a company's market capitalization and its going concern value to determine whether the company's stock is currently a good buy. So that is also a part of it, stocks. They can compare with the going concern value and capitalized value, everything. So they can take a decision to buy that particular stock of the company. When assessing liquidation value, it is pertinent to realize that the cost associated with the process. Is what I said. In liquidation value, it is pertinent to realize the cost associated with the process. Cost associated with the process means everything will be included. Saleable condition, then for selling whatever the cost comes, everything should be included in the liquidation value. That is why it is almost higher than salvage value, they said. Okay, but it is very higher than salvage value, of course. We know what is salvage value. But it will be more than salvage value in any case. And I think new judgment has come now about this, how to reduce this haircut from going concern value, fair value to liquidation value. Heavy haircuts are there now, of course. Suppose 100 crore business, they go as down as 20 or 15 crores. So that is a difficult situation is there. So these are all Indian experience. We are slowly regaining more, changes in IBC rules. IBC judgments are there. So many judgments. I hope you are all familiar with that. Go by the judgments every day. They will send you IBC judgments. So just go through it. Then only a good value will be updated with the situation. Present situation, present guidelines from IBBI, etc. Okay. When assessing liquidation value, it is pertinent to realize. Okay, next one. Exit values are distinct. No, exit and entry value. There is, in my opinion, actually, this is exit not opposite to entry value. I feel so. I don't know. Somebody else can enlighten me in this one, because exit is opposite word for entry, but in valuation, it is not opposite to anything. It is complementing each other, actually. Exit values, see the difference. Exit values are distinct from entry values, which reflects the price. Exit value we are going to talk first, okay? Which reflects the price which would be paid to acquire something. That is exit. To determine the exit value, it is assumed that the asset or liability would be transferred in an arm's length transaction, as we have seen previously. Thus, exit value is the proceeds if an asset or business were to be sold. Okay. This estimated amount is consolidated to be most reliable if the proceeds are derived from an independent third party valuation. In arm's length transaction where the sale is not rushed or not in compulsion. It is not in a rushing, with this thing. So now what is entry value? Entry value is from the outside, abroad. Whatever raw materials or whatever machineries you are importing, you have to add it, that's all. It is a reported price of an imported product based on information provided by the seller. So reported price of an imported product. It may also be referred as declared value. Declared value, that is declaration value. You can say it is a declared value. The seller lists this price on shopping documents. Of course, you have the documentations properly. The seller lists the price on shipping documents when selling the product to an international buyer. So in this case, entry value is to be considered. Not the actual value of the product. Entry value. There are some government rules here. Much they will charge, how much extra amount to be paid as for import as per export policy. Okay, so that is to be considered. So this is exit value and entry value. Now this is also very interesting value, enterprise value. Most of us are not familiar with this. Most of us means land and building and P&M. I'm that category of thing. So enterprise value. The enterprise value is calculated by combining a company's debt and equity and subtracting the cash and cash equivalents. Very simple thing. You see that enterprise value, a company's theoretical purchase price. Okay. Enterprise value is equal to EV. Yeah? EV is equal to market capitalization. That means market cap. The price current, the current share price multiplied by the number of outstanding stock. Okay, shares. You will get present market value or market cap rate. So the current share price multiplied by the number of outstanding stock shares plus total debt. What is total debt? You might have taken money from banks, financial institutions, etc., etc. So that you have to add MC plus total debt minus cash. Cash in hand means liquid asset that is in bank. Suppose you have got a balance amount, that you can use for what? For reducing the debt. That is why it is here it has shown as minus the liquid assets of a company. How much money is needed to purchase the whole company? To purchase the whole company, you will need purchase all its shares. Right? See, in simple words, all the shares. You will also need to pay off all the company's debt. Before purchasing, the debt should be cleared. So from where it will come? From some portion from your side and some from cash reduces the price as you can use it that cash with the company itself. Money balance sheet it shows. So that cash you can use to reduce the debt, total debt. Okay, that is called enterprise value. So market cap plus total debt minus cash. This is called enterprise value. So let us see an illustration. In 2016, Telsa held MC of rupees, market capital of rupees 35 billion, 3,535 billion, and liability is, liability means leverage, anything can be. Rupees taking loan. It's short in our layman's language. Liability is 1,225 billion. The company has had around 250 billion in cash in its account. So cash in hand, you can say, in account 250 billion is there. So the enterprise value is now you can calculate very easily. What is that? MC 35 rupees, 35 billion plus rupees liability 1,225 minus rupees 250 billion in cash. So that will give you enterprise value of 4,710. So Telsa's value becomes 4,710 billion. That is the enterprise value of the Telsa. Simple one. Say in company and business valuation, other methods are book value, DCF, market capitalization, EBIT, that is earning before interest, taxes, depreciation, amortization, are also used. So these are the methods out of which I think
आप रिपोर्ट खोलिएगा वो पैरामीटर बोलेगा जैसे आप
they are talking to me. Okay, anyway, this is how we calculate enterprise value. Security and finance people, if they are there, so if they want, they can give more output, I will mind after the classes. Okay. Opportunity cost. Now comes another word, opportunity cost. That is why this nameless, what you call unusual word of values, diverse values. Now comes this. You cannot by heart all those things, but when circumstances come, you can refer. Opportunity cost. Let's see. In economics, opportunity cost represents the potential gain that is lost when choosing one investment choice over another. It is bit difficult to understand. See, you have got two choices, choice A, choice B. So, you choose choice A. Okay, I will go with A. But B could have been better. So, the difference between these two is called opportunity cost. Because suppose you earn 100 rupees by choice A, 100 rupees. If you would have choice that time, the second option for 150 rupees. So opportunity cost is 50 down, the difference. That is already lost. You won't get that. That is why potential gain that is lost. This 50 rupees is potential gain. That is already lost. Because you already chose this one, no? First option. So that is why it is called opportunity cost. Clear? Opportunity cost represents the potential gain that is lost when choosing one investment choice over another investment. Then it is foregone benefit. Don't think about it, it's gone. You have surrendered it. Foregone benefit. That would have been derived from an option, not chosen. That choice is not made. So you lost the chance. To properly evaluate opportunity cost, the cost and benefits of every option available must be considered and weighted against the others. Okay. Considering the value of opportunity cost can guide individuals and organizations for more profitable decision making. So suppose manager. Yes, madam. It's asking.
No, sir, please continue.
No, somebody is talking there. If they want to ask, let them type in the chat box or anywhere. And if possible, I will answer it. Okay, the last of it. If it is not to me. Okay, with my little knowledge. Considering, so opposite can guide individuals and yes, profit. That is profitable decision making. It helps profitable decision making. Examples of opportunity cost include investing in a new manufacturing plant in Mumbai, as opposed to another less developed city, deciding not to upgrade company's equipment. There are two choices of the. One is start a project or a business in Mumbai, like a metro city, investing in new manufacturing plant, as opposed to another less developed city, like maybe Kochi or Trivandrum, Kerala, okay, less developed city, and deciding not to upgrade company's equipment. Here the opportunity cost is decision is good because our business capital is Mumbai, India's business capital, financial capital. So that is the opportunity cost. So here a small example. Consider the case of an investor who at the age of 18 was encouraged by their parents to always put 100% of their disposable income. What is disposable income? After your expenses, whatever remaining, that is your saving, you can say in a way, disposable income. You say something, no, propensity to save. Disposable income into bonds. His parents advised, your particular bonds you can deposit. It's good option. Okay, over the next 50 years, they invested dutifully, that son. 50 years, he's 18. After 50 years, they invested, during these 50 years, every year he will deposit disposable income in the bonds for rupees 5,000 per year in bonds, achieving an average annual return of 2.5%. And when he retires, he will get back how much? Around little less than 5 lakh million, because you have to use that asterisk mark, amount of rupees 1 per year is equal to 1 plus I raised to n minus 1 in values equation. Just substitute it, you will get 4.8 million. That I round it off to 5. How much? Not even 5. Not 5 million. Sorry. 5 lakh. Okay, 5 lakh rupees. Although this result might seem impressive, it is less than it is less. So when one considers the investors' opportunity cost, that is there was another opportunity there. They had, instead of invested half of their money in their stock market, he could have invested in stock market also. That time, stocks are ownerships actually, and bonds are debts. That is, company has to pay you back one day in bond. But higher return is you will get, it's ownership, like ownership, you will get more return. So they had instead invested the stock market and received an average blended return of 5%. So in that case, their retirement portfolio would have been worth more than 1 million. So just double, 5 lakh it becomes 10 lakhs, right? So yes. So that you can find out from, it is actually more than 10.04 lakhs. So I round it off to 1 million. Use this equation, and amount of rupees 1 per year. So every year you are putting 1 rupee. Values table and values equations now you are familiar with. So 1 plus I raised to n minus 1 divided by I. Okay. Substitute the values and you get this. This is called opportunity cost. He's lost this chance 50 years ago, out of which A and B choice I told you. His parents advised for A, but B could have brought him double the profit or double the pension scheme, whatever. Okay, pension. Okay. Now we'll go to next. part. Inventory. So we all know that in IBS standards, inventory is not for land and building or plant and machinery. That being good, IBS good, IBS standards. I hope you are all familiar with IBS standards now. So if not, you should be thorough with that. And until and unless Indian some laws or standards is established. So now I think all the RVOs are following international valuation standards. So inventory, the chapter that particular portion is not included in L&P or P&M. But we should go through it. Once you go through it, you will understand that some portion of it is required for us also. I will tell you why last, okay? Inventory is a current asset account found on the balance sheet, consisting of all raw materials, three main items: raw materials, work in progress, and finished goods. Keep it aside, okay? But these three items: raw materials, work in progress. During the work in progress, you are using these raw materials. So when you add, everything is the same. Here you are adding, here there you are adding as work in progress. And finished goods. It's not sold. Finished goods. Okay, finished. So this is called that a company has accumulated as an inventory. It is most difficult to, it is illiquidity. It is called illiquidity. It is not easy to get cash in hand. See, the most liquidity is pocket in your, the money in your pocket or money in the bank. Nowadays, GPay is there. You can transfer any amount. It is liquid. Liquidity is high. Whereas this is not possible. Liquidity wise. Basic formula for ending inventory. Ending inventory. It is called ending inventory is beginning balance plus purchases minus cost of goods sold. In short, it is called COGS, cost of goods sold. When sold raw materials, work in progress, and finished goods, current assets, everything is inventory. You add it together, no? It becomes the revenue when you sell it. Turned it to revenue. It is your revenue now. So inventory becomes revenue. Now, I don't know this. Probably they are using it. LIFO and FIFO. Sir, am I correct? Security, somebody is there, no? LIFO means last in, first out. That is in your godown, suppose cement bags. Last lot you give out first. Whereas the other one is just opposite, FIFO. First in, first out. First in, first out. Actually for cement especially, I will tell this, you have to follow in engineering also. Because you cannot keep cement for a long time. It will be hardened. So first in, first out. So that is LIFO and FIFO. LIFO is not realistic for many companies because they would not leave their older inventory sitting idle in stock. Now company prefers this because the first inventories, older inventories are idle now in stock. Because they are not selling the first car, they are selling last in, first out. Whereas FIFO, that is first in, first out. The most logical choice, since companies typically use their oldest inventory first in the production of their goods. This is the difference. So the table you can see. What is LIFO? Plus points comparison. This is LIFO and FIFO comparison. Increased cost of goods sale, sold, COGS increased. Whereas FIFO, it is decreased, lower COGS. Then LIFO will give you a reduced profitability, because I will tell you, reason is, suppose the first come, the inventory which is you made first choice, its value is less. Whereas last come always a higher value. You are going to sell it. Last in, last first out. So the other one you have to sell for lesser value in a future date. So profitability is reduced in that case. Whereas here, FIFO, higher the profits. You are selling for the selling price of the today's selling price. So profit will be higher. Then in LIFO, lower tax rate. That is because, of course, the profit is shown in balance sheet as LIFO. Lower taxability is tax is lowered. Whereas in FIFO, higher tax you have to pay. This is the three main differences between LIFO and FIFO. Now let us say we know cap rate and capitalization rate. Now there is overall capitalization rate, a term we use for it is arrived from WACC, weighted average cost. Actually, but for what you are giving weightage, that depends on the situation, what kind of problem you are facing, or that is called overall capitalization rate. Whether it is debt, equity, etc. Okay, there is a formula, very easy formula. Let's see the theoretical part first. We know capitalization rate as cap rate is used the word of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. That is the simple definition for capitalization rate. We know that IRB formula. Income is equal to rate by that IRB value, market value, or net income is equal, capitalized value is equal to net income into yield. Same thing. So capitalization rate is same as that formula to find out market value. It does not take into, that is simple problems we have done in MEPA classes and all. It does not take into account leverage, debt, bonds, the time value of money, etc. These are all not taken into account in ordinary capitalization rate. Account leverage, that is, what is account leverage? Loan taken from banks, an example. Leverage, then debt, then bonds, then time value of money, etc. These are all not considered. The cap rate simply represents the yield of a property or 1 year time. Only 1 year. Limit assuming the property is purchased on cash, not on loan. In ordinary capitalization rate, leverage is not considered. So you are purchasing by cash. Cash means your own amount, without getting any mortgage or anything. So cap rate simply represents the yield of property over a 1 year time limit, assuming the property is purchased on cash, did not on loan. The capitalization rate indicates the property's intrinsic, natural, and unlevered rate of return, without considering future cash flow from property improvements. This is a drawback actually. So without considering future cash flows from the property improvements. In order to include these things, disregarded expenses, that is, these expenses are not considered. Whatever expenses we are not considered in this capitalized value, like leverage, debt, bonds, or whatever. Okay. So this is when we consider in the calculation, it is called overall capitalization, which is more realistic. Overall capitalization rate can be adopted by using same as WACC, weighted hurdle rate. You know it. So how to find it out? We'll see some example. As it is common that of business run on borrowed funds, the cost of capital becomes important parameter in assessing firms' potential for net profitability. The WACC formula uses both companies' debt and equity. Both we are taken into account, debt and equity. Okay, so that is the significance of overall capitalization rate. Not ordinary capitalization.
Recording in progress.
Okay. So many companies create a higher WACC usually coincide with business that are seen as riskier. We know whenever your return is more, the more risk is involved in that particular business. So that are seen as riskier, more riskier. Risk factor is more. Need to compensate investors with higher returns. Okay. Many companies create a capital from a combination of debt and equity, such as stock. Almost all companies, registered companies. Equity and debt financing. To express the cost of capital in a single figure, one has to weigh its cost of debt and cost of equity proportionally and based on how much total financing is acquired through the e-source. So here we are going to find out it in a very simple equation. WACC equal to E by V into RE. R is always right. Okay, plus D by V, I will explain, divided by RD. So it's another rate. Multiplied by 1 minus TC. There are two components there. X factor. Okay. That is why 1 minus TC has come. Now, where E is market value of the firm's equity and D is market value of the firm's debt, then we consider E plus D. That is market value of company's equity plus market value of firm's debt. That is called V. R is cost of equity. RD is cost of debt. TC is corporate tax rate, whatever the tax. Okay. This is the simple equation. Just go through it. Further explanation, I think maybe take another class. Okay. So this is the equation for finding out weighted average cost. A simple example, like illustration, I can show you. See, Mr. Kiran offered the property to purchase with a vendor from first mortgage. Yes, first mortgage is 40% purchase price of rate of 11%. So the rate of interest is 11% for 40%. And another 30% second mortgage. It has got the interest rate of 15%. So 30% of total purchase cost is from second mortgage. That is, but charge is very high, 15%. The purchaser requires a 12% return on equity. So 12% is expecting as equity return. What is the overall capitalization rate achieved? This is the question. So solution is weighted average cost. You find out only WACC. That is 40% of 0.11, 40% of 11%, plus 30% of what? 15% rate of return, 30 into 0.15, plus what is purchaser's equity? That is remaining 30%, 40 plus 30, 70. Remaining is 30 is purchasers. So 30 into 0.12. He expects a return of 12%. So If you do this math, you will get 12.5%. So this is the overall capitalization rate achieved, 12.5. Now I will tell you one thing. We are calculating 100 by 12.5, right, for calculation of yield. Here, you will get another aspect is how many years it will take to get back your investment by dividing it by the 100. See, the ratio also indicates the duration of time it will take to recover the invested amount in a property. In this case, a property is having a cap rate of 12. Here it is 12.5. Take around 8 years. We know that 100 by 12.5 is always 8. You can check it. Okay. So within 8 years, he will get back his investment. In simple terms. So while working out overall capitalization by WACC, you will get another interesting factor of how many years it will take to get back my investment. Just divide it by 100. So you get 8 years for recovering investment. 100 by 12.5. Also IRB formula. Okay. Now let's go to easement right. This is very important. Important in the sense most of the people are not taking this easement right in valuation reports. But if you take it, if you learn it how to value it, this will be very useful to you and impressive for those who are knowledgeable about easement valuation. Peer view, whether it is in peer view or IDV or whatever. Okay, so easement right, there is a lot of misinterpretation in evaluation here in the easement right. Okay, so generally, first of all, you should know this is a confusing term: dominant owner and servient owner. Be sure with who is dominant, be servient, who is servient. Who can say with an example? Who is dominant and who is, I will give you an example, okay. Then you tell me who is dominant, who is servient owner, okay. The word servient comes from servant, etc., etc. So, plot A is frontage. Plot B behind it. Okay. Plot B, you have to go through plot A. That is front plot A. Here, who is dominant? Who is servient? Tell me. Please cooperate. I need an answer from this. Who is dominant owner? Plot A or plot B? You can unmute if you want. If you cannot unmute, you can chat in chat box, you can write. Plot B, very good. Plot B is dominant. He is dominant. Who is going through A? Plot A. His right of A is through A. Plot A. So he is dominant, and most of us are confused with this one because it is my plot. He is going through my plot. So I am dominant, he is servient. No. Once the dominant right is given, easement right is given, he is dominant. And you are servient, the plot A, frontage plot. Balbir Singh sir, you are L&P? See the answer from me. Okay, anyway.
In my opinion, it is B is dominant.
Dominant. Right, survey,
What is it?
your opinion is the plot B is dominant, right?
Yes, sir. Yes, B is
Yes,
dominant.
exactly. Your answer is exactly right. Most of us are confused sometimes. Naturally, they will think plot A is dominant and plot B is surveyed. Okay, so this is enough. It is enough to know these two terms. Then the other things are immaterial. That is problems will solve. Okay, okay, very good. Anyway, easement is not only for right of way, right of light, light of air, right for what you call access, everything. It is included in easement rights, not only the right to take your car inside and all. Light is there, air is there, wind is there. So many aspects of the easement that we'll see. It's another CEP. Let us see. So, dominant heritage. It is considered by some values that the reduction in value due to appendage of an easement may be to the extent of 50% or so, depending upon the nature degree of transfer. This reduction is applicable to dominant heritage because it has comparatively more disadvantages, inconvenience, and hardships. Instead of this ad hoc reduction, it is better if valuer estimates deduction on the basis of accurate working and on factual data. There is some methods of the R.K. Gandhi's famous author of Elements of Valuation Test given. So factual, how to work out factual data, work on accurate work. Okay. So I will give you some examples. Now, see simple examples we'll see now. A plot A having 1,000 square meter is acquired by government. Compensation is 5,000 square meter. The adjacent plot B, ground floor consists windows on total 20 meter open out to the plot A. Calculate the value of easement right of dominant owner. Minimum joint open space is 3 meters is required for a adequate calculate value of easement right dominant owner. This is for light. Okay, minimum joint open space. Open space is given 3 meters is required to adequate light of the building. So here it is very simple. Simple means there is a court order, that is right. Okay. Notional land area of the lighting. Let us see. That is, you see, the total window opening is 20 meters horizontal. Excuse me, please, 1 minute. The plot A is having 1,000 square meter is acquired by the this is over. Okay. So 20 meter that windows are opening to for lighting purpose on plot A, but it is acquired now. Minimum joint open space that is 3 meters. We know that we will have some offset 1.5 meters each. So minimum total 3 meters is required for adequate light on the building. That is why we are providing this offset rules and all. Front offset, mismatch, side offset, mismatch, all those things. So that the other person will not be suffered. So 3 meters is required. So this 20 into 3, 30 square meter is the, no, sorry. Okay. Notional lighting is 20 into 3, 60 square meters. 20 meter window area multiplied by 3 meter offset area. See, it is like this. So it is, we are converting the land area. The same thing, shadow like, 30 meter. This entire working is based on notional concept of necessary land area for light, and only token of 1/4 value is decided by the court. Actually, you need not pay for entire 60 square meter. That is court order tribunal actually. Dr. Banerjee, President of Improvement Tribunal in case number 130 and 1980. So there is a court order, you have to give only 25% of the land value. So 25 means 1/4. 1/4 of total area is 5,000 square meter into 60 square meter is the land area. What is that? Notional land area. You understand? Because he has to close his, maybe the, what do you call it, windows. Or many cases are there. So actually the dominant owner is in trouble now. So you have to make up that with the 75,000. This is the one question, one example illustration. Then we'll have some more. See, there is another illustration for right of access. Okay, this is not for light. This is right of access, right of way. This particular example. The dominant owner of plot 2 holds right of way 4 meter wide and 9 meter length through plot 1 in front of for a rent of 1,000 per month to survey and owner. He is paying the survey and owner 1,000 rupees for a way, roadway for 4 meter into 9 meter. Lengthwise it is 9 meter and 4 meter. So 9 for 36 square meter. Okay, so he's paying per month 1,000 rupees to the owner of this plot, first plot. Plot A. Plot A is acquired for unit price of 5,000 rupees. Now the story begins. Plot A is acquired for unit price of 5,000 square meters per square meter. There is an alternative access to the plot 2. Now plot 2 is, see, he has got another option actually, but it is expensive bit. This is an alternative access to the plot through plot 3. Another plot is there, or plot C you call, with a width of 6 meter and 50 meter. He has to take 6 meter and 50 meter length. Unit rate of land of this plot is 6,000 square meter. It is expensive compared to the other one. Calculate value of easement right and claim damages for total extension of easement. Extension means it is over because it is acquired. There is no more plot A acquired for maybe for land acquisition, whatever. So claim damage for total extension of easement right. Extension of easement right is rare actually because even it is transferable. But in this case, it is extension means ceased. It is finished. No more easement right is there. So total extension of easement right of dominant owner. Okay. So solution for this particular. You read the question thoroughly, then you understand. Here I will change to what is the wrong word? 1. Right? So there are three plots, first of all. So first plot, road frontage plot is first plot, second plot is dominant plot, and third plot is also he can take a right of way, right to access his plot, dominant plot. This is the picture. You visualize the picture so that you will understand. So when it was the first plot was there, he is paying 1,000 rupees. Now first plot is gone. You don't have a way through that. His another alternative is from C. That is more expensive. So what will be the damage to be paid to him? That is the question. So value of easement right for access of by capitalizing annual rental value is 8% at perpetuity, 10%. So we'll see these are all generally considered perpetual, lifelong. So value of easement right for access by capitalizing annual rental value is 10% is, as we know, 1,000 per month is paying. So convert that one into a per annum multiplied by 12 into 100 by 8 yield. So that you will get 1.5 lakhs. So that is number one. Number two, amount payable for purchase of alternate access. So that is area how much? 6 into 6 meter wide and 50 meter width. 6 into 50. What is the price? 600 per square meter. Multiply with 600. You will get 18 lakhs. So you will get 18 lakhs rupees from amount payable purchase of alternate. Total claimable amount for dominant owner. So he is the person who suffered by all this acquisition and etc. So total payable is add these together. His a capitalized value for 1,000 rupees plus amount payable for purchase of alternate land also. So 1.5 lakh plus 18 lakhs. So he should get 19.5 lakhs. 19 lakhs 50,000. This is how easement rights are. This is another CEP actually. For time being, this much is enough for you. You can go deep to this subject by Googling or by buying some books in easement rights. You find this type of issues and verdicts, court orders for easement rights. So a good value should be, as I always told, updated. You have to update your knowledge. That is why the CEP programs are there for you. I don't think simply getting 1 or 2 credit points is not the aim. We should get, I am attending so many CEPs from so many RBOs. New subject, if it is new to me, the subject is still doing it. We need not consider the credit points or simply switch off the camera. For a successful, as a successful value, you have to put some effort on it. These are all guidelines, this type of norms. So please do that. Yeah. So next 15 minutes is given for discussion. So if you want to ask me something, or share something more, I can do it for you if it is possible. Otherwise, you can start anything.
Hello,
Yes,
can you hear me?
yes, Kuldip ji.
Good evening, sir.
Good evening.
Sir, I have one question. It is not related to what you were just talking. But I would like to know. I'm a PME earlier. Facing many problems while doing valuation. Can we discuss few of them?
What is that? Can you precisely describe? I cannot hear you clearly, or you louder, please.
Okay. See, I'm a PME valuer.
You are a
Plant and machinery valuer.
okay. PM.
Facing many problems while doing valuation. Such like the required documents not available. And finding acquisition cost of any plant, etc. Then how we will tackle all these things, because if any plant is there, plant manager or landowner not giving us documents, only giving you book of account for last year, and asking us to do valuations for not giving any invoicing and acquisition cost of that, and then how we will proceed in this.
Okay, the recent one P&M valuer is disqualified because of this. You may be knowing Mystery Alam. What is his name? It was there. See, without proper documentation, never do any valuation. You reject the assignment. You can reject. Some other people may do. They are in trouble. But this is company valuation. IP or whoever given him the assignment should provide whatever document is required. Otherwise, you can you write it. CLD is there, no? Caveats, limitations, and disclaimers. Enough document is not produced. Only you have got this much. My inquiry assumptions and from inquiry, your assumptions, special assumptions, caveats, everything you can write. So without my request is to this, we are also facing as an LNB. They may provide us only the primary deed. Then by site visit only, we can do some kind of inquiries to the local people. What was running here? I will tell you one thing. This plant and machinery, when I visited one site for liquidation purpose, there were buildings, first floor, ground floor and first floor. All machineries, they are taken away. When I visited the same day, the bulldozer was working in the first floor. Wall are dismantling. They are taking out the machineries. So this kind of things happens in life. You know, they even threatened me. I took photographs. Most of the cases in liquidation, I'm telling you, this is happening. Now, for CRPC process, you have, that is going on concern. All the details are there, right? Most of the time. Now, banks are, I don't know what they are doing there. Okay, if you can give me the case study, you can send the case study, what the real case study, I can give you a reply. Because banks you can easily tackle. They don't know anything about this thing, to be very frank with you. Valuations. Not like IPs or RPs. They are well educated, but in our field, because of our this field is known to tragic part is most of the people are not knowing what is valuation in banking and financial institutions. Now they are asking something, appendix format A to be attached. What is this format A? It should be enshrined standards enshrined in IVS. Then what is IVS? They don't know even the full form. I asked my manager. I lost that job. That is different case. Without knowing IVS, how you are going to write this format E? That now all the banks are asking for either by the word they are using is annexer 1, annexer 2, or format E, format A, format C, whatever. So to fill these things, one must be thorough with IVS standards. Now, in IVS, it is clearly stated that without evidence, you cannot do any valuation. You have to provide evidences. From where you get land value, from where you get machinery values, depreciated machinery values. As a P&M valuer, you have to justify it. So original bills are with you, whether they can provide original bills, well and good, you can depreciate it. Right? And in balance sheet, they used to do in return down value method. It may not be the same as market value at that stage, for banks. If it is a going on concern, you have to use another method. I think you are using linear method. Constant percentage method is mostly used for movable property values. Movable means machineries and equipments. Do you have any other doubt? I think this is the question you asked me.
Yeah. No, thank you.
You ask don't bend your, their needs. For their needs, don't bend yourself. Ask them to provide this thing, this thing, this thing. If it is running, that is going concern. They have all the documents with them. Whatever documents suits you, you have to get it.
This property is not in going concern. This is an ideal position.
Then it is a issue.
They have acquisitions in 2020 and they have a balance sheet book of account for 2021. But last 2 years, the plant is in ideal condition and now they are going for the bank for the loan purpose and they requested for valuation to me.
Again, they want loan. They are not working 2 years.
Yeah.
Did you visit the site?
Yeah, I have visited the site.
The machineries are there?
Yeah. All the machineries are there and all the maintenance are going on. Everything is
then you can certify. You can certify it easily.
As per required site and as per detail given by them, everything is on site.
And then it's fine,
because
sir.
They are going to start the plant in next 6 months because the maintenance is going on. And they have provided that last 21 to 30 years data for production system. And it is as per the required.
I think you don't want it actually. You need the price of plant and equipment, original price. That bills will be with them. Their books of account. It is there.
So we can do the valuation by their books of account only.
Yes. Purchasing value is okay. The historical price you will get from books of account.
But they have provided
purchasing price, depreciation you can do yourself.
Okay.
Depreciation is it is up to you how to do, which you might have learned maybe constant percentage method or
they
any other
method. They have purchased that one in 2020 for some cost, and they have done some improvement in that for some cost. So now the book of account showing some cost. So can we depreciate for last 2 years?
Of course, why not? I think so, because generally land building lasts for 60 to maybe 80 years or 75 years, whereas your time period is shorter. So 2 years is depreciable. To 15 years, maximum your one machine has got a lifespan of 15 years or 10 years or 12 years, right? Lifespan, total lifespan
Okay.
is
So, this
well
is
below an L&B asset.
And this is a big plant, and they have installed it here in 1991.
See, it is your judgment, sir. If you feel that, see, their maintenance is good, it looks as new, you can adjust the depreciation. It is up to your observation, sir.
Okay.
Your judgment, values judgment, because you are a judge in value. So how much depreciation is to be given is depending on your observations. You feel that it is good, whether it is purchased in 20 or 18, 2018 or 2020. You can write always observed age.
Okay.
Observed. If no other possibilities are there, you can write observed age. I observe it as a new one. I observe maximum 1 year or 6 months. Something like that. Banks will definitely accept it. No problem. Whereas in company valuations, it is a very difficult task.
Yeah.
I took one P&M valuer to a site for company valuations. Assignment, CRPC. But not the CRP, sorry, liquidation purpose. So while we reached there was no machineries there. And half of them are not in working condition, rusted. Rusting, it is more than 30 years, 20 years, it is closed down. Even land is acquired by somebody else, forest department, some portion of the land. This I came to know from a coffee shop. I told you, no, a small coffee shop is there, that village. I talked to him, sir, forest has taken our land also. You check forest department, they are acquiring this land also, they acquired, we know. Then I go to the forest department, they were waiting for a owner to come to disperse the amount. Then I told the owner, because owner is no more, unfortunately. That is why it is become default. And his relatives, like his spouse, doesn't know anything about it. Daughters and boys, they are not also not involved, so they don't know what is happening. Anyway, they got what you call acquired portion, 10% of acquired that land. That amount forest department has paid them because of a tip from a coffee shop. Otherwise, I will also write the whole area 100%. But fortunately, the forest department has that information is given by this coffee shop fellow. So it was just mere luck, their luck. They got some amount relief from that. So these things happens. So in company valuation, haircut is more liquidation purpose. But your case is not even that one. It is easy for you.
So actually,
And he is asking me that P&M value, what I will do. He says, if I prepare it, it is negative value because some portion has to take it away from the embedded, some foundation is there. You have to demolish it. They have to take it away. So cost should be, who will bear the cost? So the value will be negative. There is no plant and machinery cost there. So I told you, said you finished. We closed the chapter there. It is for P&M, it is nil. Then I have done for land, of course, we can do that. Land and building values. Highest and best use for this property is making something else. So I don't remember, but I have considered. What is highest and best? You know, financially possible, legally permissible, and physically feasible. All those things. That is highest finance return you will get. But it should be legally feasible, legally permissible, and physically feasible. This is highest and best use, Habu principle. In liquidation, you can use Habu principle because the rest is only land. The land, what you will do with the land, the purchaser, the prospective purchaser. So we should give the best option. That they use for anything else. Sometimes for good godowns. You can suggest godowns. This is a place where the industrial units are there. They can use it as a godown places. Divide it for godowns. Or if it is a residential area, okay, give for residential purpose or commercial purpose. Buildings, supermarkets. That you can study it from the market study. You must know what kind of property has got demand in that particular area. It depends. Okay, any other question? No, don't say thank you, please. I'm just like a valuer like you. And whatever I know, I share it. That's all. You can be also one day. Well, you can, of course. I think there are so many other valuers better than me. Usually it happens in CEP classes. We don't know each other. But fortunately, I have a chance to pass this exam in 2018. It's a first batch. So they selected me as a CEP by that time. But one thing I will tell you, sir, to become a this profession is now the highest paid or whatever you call most sorted after, some people say, valuation. But to be a successful valuer, I always say to my colleagues, please, you go for further studies, update your knowledge, get the books. So many books are there. You may be knowing R.K. Gandhi's Elements of Valuation, Shyamala Datta Saab's book, what is that? Mastering Valuation. That is MSc valuation in UK. It is a curriculum. Curriculum. This book is included. It is available in 1,500 rupees. Get it. Those who are not having, get the Mastering Valuations by Shyamala Datta. Just type it in Amazon, you will get it. 1,500 rupees. It's a very valuable book. Is from West Bengal. Very good valuer. Then Sabhavi sir is there from Tamil Nadu. Jairam sir is there from Tamil Nadu. Ashok Naina sir is there. He's also from Calcutta, I think. Mahendra Kapule sir is there from Mumbai. They are all authored so many books. Now get those books and you go through it. You can understand it. Simple language, they are given all the things, all approaches, how to value, and what are the see, nowadays company valuations are very strict. You know, penalty clauses are there. So you must be knowing that the subject, how to write the report, what IBBA is expected. Accordingly, you have to prepare the valuation reports. So, any other questions? You have a doubt from LNB, anything you can ask. LNB, I'm an LNB value. Gowda Saab, Lakshkant Gowda Saab. Anything you want to ask me? Surjit Sethji, tell me. Ranbir Singh sir looks a bit retired from government service. Am I right? Ranbir Singh sir, you are retired from government service?
I am retired from army, sir.
Army. Oh, salute.
Thank you, sir.
Anything else? Or we can conclude here. I think almost time is there. It's 6 o'clock. Your family is waiting for you to have a filling or something. Oh, there are so many people. I didn't see them. Now they are open. We will take a, in that case, I go for this one. Or full screen. So it was a nice interaction with you, really speaking. Even every CEP class for me, it's like, tension, because I don't know how much I can clarify your doubts. But fortunately, there are not much doubts from your side. If it is there, sometimes I will also be in trouble, to be very frank with you. So,
Sir, I think there are no more questions from the participants.
No, ask me, ma'am. The chat box.
Sharma sir, are you there?
Yes, I am here. Please.
Sharma sir is
Okay,
not audible.
Who is not?
So
I'm
I
not
think,
audible.
sir, we can just close this session. And thanks to all our participants and thanks to Kumar sir. It's a wonderful session. And our participants have enjoyed and gained their knowledge. So thanks to all, sir.
Thank you very much. Shall I leave that presentation now and leave the webinar? You're all going, not disperse, or you discuss if you want. Anyway, my role is over, I think. So let us close the session.
Yes, sir, we can now just close
Yes, sir,
the session.
So 2 hours is all okay. Yeah, time is not an issue, but for me at least, we are seeing. Okay, fine. Now I'm looking for an exit. I cannot find here.
Okay.
Speaker. Exit full screen is there. Leave. Okay. So I'm leaving. Have a nice day.
Okay,
Your
sir.
day
Okay.
nicely. Okay. Bye.
Okay.